As we check the numbers right now, the United States stock market is currently closed and Opendoor Technologies, Inc., trading under the ticker symbol OPEN, finished its latest regular trading session on July 15, 2026, at a closing price of $2.14 per share. This represents a downward intraday market movement of 2.3% from the previous opening price, with a trading volume that slightly outpaced its 20-day moving average. While most retail investors looking at their individual brokerage applications see this as just another standard drop in a volatile real estate technology market, a closer look at the institutional order flow tells a completely different story. While the public narrative centers around a sluggish housing market and high interest rates, block trades executed in the final hour of the session indicate that large institutional funds are quietly accumulating shares at these depressed levels, positioning themselves for a structural shift in the real estate transaction model that the broader public has entirely overlooked. The common ground among most market participants today is that Opendoor is a distressed asset permanently trapped by the macro environment. If you browse popular investing sites or check discussions on a standard Robinhood app, the prevailing consensus is that iBuying is a failed experiment. People look at how the company struggled when interest rates skyrocketed, and they assume that until the Federal Reserve aggressively cuts rates back to historical lows, this stock is dead weight. This expectation of continued stagnation is exactly what creates the current tension in the market, because the underlying reality is shifting away from that simplistic view. The company has quietly overhauled its risk management algorithms, tightened its buy box criteria, and shifted its focus toward a capital-light marketplace model rather than carrying massive amounts of high-risk inventory on its own balance sheet. Investors who are busy chasing high-flying options on Tesla stock or trying to catch the next leg up on Nvidia stock are completely missing the operational discipline that Opendoor has integrated into its business over the past 12 months. When you look at the recent stock movement over the last quarter, the price action has been characterized by sharp algorithmic liquidations followed by extended periods of quiet consolidation. This pattern usually suggests that retail capitulation is matching up against patient institutional accumulation. On days when macroeconomic data drops, like inflation reports or housing start metrics, the volatility in Opendoor stock spikes significantly compared to mature tech giants like Apple stock. This volatility is precisely what attracts active traders using an interactive brokers platform, where interactive brokers' stock trading fees allow for high-volume scalping of these low-priced equities. However, the real story lies in how the stock has established a firm technical floor despite multiple waves of negative sentiment hitting the broader real estate sector. The trading volumes during down days have been visibly drying up, which indicates that the selling pressure is exhausting itself, while the up days are accompanied by noticeable volume surges that suggest institutional accumulation is taking place under the surface. This institutional activity is crucial because it highlights the growing divide between retail perception and professional capital positioning. If you open a Fidelity mobile app or manage your accounts through Fidelity Investments, you can see that institutional ownership has remained remarkably stable despite the stock trading at a fraction of its all-time highs. Large asset managers handling Fidelity mutual funds and constructing diversified portfolios with Fidelity ETFs have not completely abandoned the real estate technology space. Instead, they are treating this as a long-term speculative option on the digitization of residential property transactions. This is very similar to how professional managers use a Schwab Intelligent Portfolio setup or an intelligent portfolio structure to balance high-risk, high-reward individual stock picks against stable index funds. The reality is that while the public expects a sudden bankruptcy or an endless dilution of shares, the balance sheet shows enough cash runway to sustain operations until the residential real estate market returns to a normalized transaction volume. To understand where Opendoor stands today, we have to look closely at what the company actually does and how its core business model operates. At its heart, Opendoor is designed to solve a fundamental human problem, which is the friction, uncertainty, and prolonged timelines associated with selling a residential home. The traditional process requires real estate agents, staging, open houses, inspections, negotiations, and the constant risk of a buyer's financing falling through at the last minute. Opendoor replaced that traditional friction with a direct digital proposition. A homeowner requests an offer online. The company utilizes vast data sets to assess the property value, and within days, a guaranteed cash offer is presented to the seller. If accepted, the company takes ownership of the property, handles any necessary light repairs, and then lists the home for sale on the open market. This process requires significant liquidity and exceptional pricing accuracy, because even a minor miscalculation in property valuation can lead to massive losses when multiplied across thousands of homes in dozens of metropolitan areas. Historically, this business model faced a severe stress test when the rapid escalation of interest rates crushed consumer demand and caused home prices to decline in key markets. The initial version of their valuation algorithm failed to predict the speed of the market slowdown, leaving the company holding billions of dollars in overvalued inventory that had to be liquidated at a loss. This historical performance is the primary reason why many users of online investing platforms and self-investing tools remain deeply skeptical. When people look for investment help or read analysis on various investing sites, the ghosts of past earnings reports still loom large. The massive net losses reported in previous years created a narrative that the company could only survive in a zero-interest rate environment where property values rose automatically every month. This structural vulnerability forced the executive team to completely re-engineer their approach, moving away from pure inventory ownership and developing a third-party marketplace that connects traditional buyers directly with home sellers, effectively mitigating the balance sheet risk that almost destroyed the business during the initial downturn. As we look at the broader economic landscape, the macroeconomic pressures facing the housing market continue to dictate short-term price movements. High mortgage rates have created a lock-in effect where current homeowners are reluctant to sell because they do not want to give up their historically low fixed-rate mortgages. This has led to a severe shortage of existing home inventory, which severely limits the total addressable market for online investing platforms that focus on real estate assets. For anyone engaged in online investing through a Fidelity brokerage account or managing capital within Fidelity Wealth Management, it is clear that the real estate sector has been one of the most challenging areas to find consistent returns. Yet this exact environment of restricted supply and suppressed transaction volume is forcing the industry to adapt. Opendoor has been expanding its partnerships with major home builders, offering a seamless trade-in program where a buyer can sell their existing home directly to Opendoor to fund the purchase of a newly constructed house, creating a highly predictable pipeline of transactions that bypasses the stagnant existing home market. Comment below how many shares of Opendoor you currently hold, or if you think the housing market will turn around this year. Engaging with the data helps us understand the collective sentiment of the market, especially when dealing with a stock that evokes such polarizing views across different trading communities. Whether you are executing short-term trades on a Robinhood trading platform or adding small positions to a long-term individual brokerage account, sharing your perspective on these specific operational challenges helps clarify whether the retail community is buying the turnaround story or expecting further downside. Looking toward the future outlook, the trajectory for Opendoor involves several distinct scenarios that depend heavily on both operational execution and macroeconomic factors. The optimistic scenario relies on the continued expansion of their capital-light marketplace model. If the company can successfully act as a digital matchmaker between buyers and sellers without taking massive inventory onto its own balance sheet, its gross margins will improve dramatically, and the capital efficiency of the business will mirror that of a software company rather than a traditional real estate brokerage. This shift is highly anticipated by analysts who track tech platforms on Interactive Brokers' platform systems, as a higher margin profile would inevitably lead to a significant upward re-rating of the stock multiple. In this scenario, the current low stock price represents an asymmetric risk-reward opportunity for investors who are willing to tolerate high volatility in exchange for substantial long-term upside. Conversely, the downside risks cannot be ignored by anyone practicing prudent self-investing. If mortgage rates remain elevated for the next several years and the broader U.S. economy experiences a severe recession, consumer confidence will drop even further, causing residential transaction volumes to hit new historic lows. Under such conditions, even a capital-light model might struggle to generate enough fee revenue to cover fixed corporate overhead costs, forcing the company to draw down its remaining cash reserves or seek dilutive equity financing. Investors managing assets through SoFi Active Investing or utilizing a SoFi robo-advisor must constantly weigh these structural risks against the potential rewards. A prolonged housing depression would test the limits of the company's newly redesigned valuation